So let's talk about a little bit of that development. I want to ask you about your growth perspective. So in 2020, you wrote a piece called The U.S.-China Divorce, The Rise of the Mexican Decade. And then you recently followed that up at the end of 2023 with The Mexican Decade, The First Derivative is Here. So can you
Yep.
maybe walk listeners through what was the original piece in 2020 about? What was it calling for? How has that played out? And then where are we today?
Yeah, so it was originally it was first published in December 19. Basically, what we were seeing is that there was a necessary shift go at a macro level that would a shift from supply chain efficiency to supply chain security. Basically, because the West was and is significantly, if not irremediably, dependent on China. It's not a good idea to depend for your supply chain to depend on your geopolitical enemy, your geopolitical rival, if you want to talk about it that way, but definitely not somebody that you're actually threatening to go to war with. And it never was a good idea. It was never a good idea, that type of concentration. Mexico in the 80s, early 90s was experiencing significant growth, decelerated for a lot of reasons. One of the reasons was that Mexico entered a de facto commercial war with China. So we were competing for the same markets with a very similar strategy with China, and China won. What's happened now is that China is out of the investment equation. They're definitely still there in the international trade and the international commercial market, and they will continue to be there. This is not the end of globalization. It's not possible to end globalization. What we are talking about is the more essential part of the supply chain needs to relocate to areas where security and access to that supply chain can be guaranteed. And we can talk about a lot of options, but the reality is that that's governed by proximity. You cannot control something that's across the ocean. So we use the term Mexican decade. We don't really like the term, we use the term Mexican decade, we use nearshoring. We don't like the term of ally shoring that a lot of people throw around because we don't think it covers the actual situation. I think from the US perspective, the US likes to pretend that there's a lot of options out there, but there aren't. If you invest in India, well, container ships have a very, very contentious relationship with torpedoes. They don't get along. So no, it does not give you supply chain security. China has the largest submarine fleet in the world. If you ever had a conflict with China, you'd be cut off from that supply chain. So ally shoring does not work. Proximity does. So it is nearshoring. The US would ideally like reshoring. It can't do reshoring. It has a deficit of 5 million qualified workers today. Only about 16% of US high schoolers wants to work in a factory. The US has, not completely, but it's significantly deindustrialized. And the only way to reverse that, it would be to open its doors up to massive amounts of immigration. That's politically unfeasible. We're seeing that the immigration is becoming one of the key issues for the election, and it will continue to be that. We don't see that change. Canada doesn't have a population. The only people that have somewhat available workforce and somewhat of a spare capacity is Mexico, and the rest is Central America. Mexico cannot substitute China, by the way. We don't have enough people. We don't have enough spare capacity. We can only cover this essential part of the supply chain. Usually that the essential part is actually also the more value add, lucrative part. So that's still incredibly attractive for Mexico. We estimate that that's going to be about $17 billion in additional foreign direct investment per year for the next decade, which will, back in 2020, we started saying Mexico is going to be growing at approximately an annualized growth rate of 3.5% to 4% over the next year. We're already there today. This year, we're slowing down, and it's kind of uneven. The sovereign states in Mexico, they're growing at 6% right now. It's going to slow down this year, but going forward, we're actually upping our estimate to about 4.5% of annualized GDP growth for the next decade, next 15 years. Basically, Mexico needs to increase 2.5 times GDP in the next 15 years.
So when you say Mexico can't compete with China, are the industries you expect Mexico to be competitive in and compete with, then, are those the first derivative industries that you mentioned in your most recent piece, which were automotive, aerospace, and machinery and electronics?
Let me explain that. We can't compete by population. We can't substitute China. We cannot substitute China by simply because of size. So China has an effective size of the Chinese population that lives in an area that is subject to its industrialized region. It's about 400 million people. So you're talking about 3 times Mexico. So we can't really compete. We can't substitute 400 million people. Mexico is at historically low unemployment rates. We've never had lower unemployment. So we are already in a very tight labor market in Mexico. So that's what I mean, that we're going to be picking up the most essential industries and the most necessary industries, and we're going to have a double impact. We're going to have the growth in these industries, and then we're going to have the increase in the multiplier, in the valuation multiplier. Mexico has some of the cheapest stocks, well, a little bit less cheap than they were a couple of years ago, but overall, some of the cheapest valuations for corporates across the board. Yeah. So it used to be that it was possible, not usual, but you could buy a Mexican private company for 2-3 times EBITDA. You could. Those valuations are going up. We're certainly not at levels where you see it in the US at 12-15 times, right? Which usually in the US, buying at less than that tends to be distressed territory and highly specialized strategies. There are some funds that will tell you they still do it, and I'm sure some of them can do it and do it successfully, but it becomes a very, very specialized game if you start going for those valuations. The reality is, in Mexico, those valuations were available across the board if you knew where to look. They've gone up. It is getting more expensive, but we're going to have growth and we're going to have valuations. So that's a very interesting dynamic. Additionally, there's a very low availability of credit in Mexico historically. That's one of the reasons that the peso is appreciating, by the way. So a lot of people are asking, why is the peso appreciating the way it is? Well, part of it is that fundamental demand for the peso has gone up. So we have increased demand for the peso because of nearshoring. Exports. Less Mexican corporates are actually investing at a record level within their own plants. So CapEx in Mexican firms has gone up. So instead of families taking dividends, putting them abroad, they're reinvesting them into their own firms. Then we're having an increase in foreign direct investment, historical level of increase in foreign direct investment. And we're having a historical increase in remittances from workers. It's actually a very positive cycle that we're going through right now. That, of course, means higher demand, but additionally, very low supply. Mexican banks don't like to lend. They are some of the most profitable banks in the world, 20-25% ROEs, and that's lending to large, very AAA clients. So basically, if it ain't broke, why fix it? They're very happy with their business, right? Their business model right now is very, very good. Some banks like BBVA. BBVA, it's not really an international bank. It's a Mexican bank. I believe it was 80% of their profit comes from Mexican profit. It's just a very, very lucrative banking franchise. That means that corporates, both large and small, are under leverage. Small and Mexican SMEs basically are unable to access credit almost at any price. So you come into Mexico, if you're able to bundle the companies together, get them to a certain size, sophistication, clean up some of their accounting issues, which are becoming less and less because of unlike the US, Mexico, most of Latin America, you're based in Brazil, most of Latin America now uses digital invoicing. And that has significantly improved governance and accounting across the board. It's become much, much more difficult for companies to evade taxes, to have double bookkeeping. That used to be a very, very important issue 10, 20 years ago. It's rapidly decreasing in importance, and contingent liabilities in Mexican firms are much easier to manage. Not so much the governance part that we discussed, but the contingent liability part, the potential fiscal liabilities, that's not the issue it used to be. Anyways, going back to this. So that means that it's now possible to help these companies access leverage, which means that you can also include a third value generation lever, which is actual adding lever to your investment. So it's a very attractive combination that's setting itself up in Mexico.